Agribusinesses, especially in developing countries, often struggle with one of the most critical components of success: finance. Without access to funding, even the most innovative agricultural ventures may fail to thrive or expand. This module explores the various sources of agribusiness finance, their characteristics, advantages, disadvantages, and how to assess the best options for different stages of the agribusiness life cycle. Finance is essential for procuring land or equipment, purchasing seeds, inputs, or livestock, paying labor, marketing and logistics, expanding operations, investing in post-harvest handling or processing. Because agricultural businesses face seasonal income, unpredictable weather, price volatility, and high initial costs, financing options must be carefully chosen and strategically applied. 1. Family and friends. Informal, flexible, and often interest-free can damage relationships if repayment fails. Lack of formal structure may lead to disputes. 2. Cooperatives and associations. Farming groups or cooperatives offer soft loans or inputs, often supported by development agencies or governments, encourages community solidarity and shared resources. 3. Microfinance institutions, MFIs, provide small loans to individuals or groups, require minimal collateral or guarantors, higher interest rates than traditional banks. 4. Commercial banks offer large loans with structured repayment, require strong collateral and formal documentation, suitable for scaling operations, purchasing machinery, or building infrastructure. 5. Government agricultural schemes includes grants, loans, and subsidies. Examples: Anchor Borrowers Program, Nigeria, BOA loans, often have political or bureaucratic hurdles, highly subsidized, and favorable interest rates. 6. Non-governmental organizations, NGOs, and donor agencies offer grants or technical assistance, usually project-based and tied to specific goals, e.g., women in agriculture, climate-smart farming, may not be available year-round. 7. Venture capital and angel investors, typically interested in agritech startups or scalable agribusiness innovations, exchange funding for equity, ownership, and decision-making influence, suitable for modern agribusiness models, e.g., agri-fintech, food processing, smart farming. 8. Crowdfunding, raising small amounts from many people via online platforms, requires marketing, trust, and visibility, less common but growing in popularity. 9. Agricultural input. Financing suppliers give seeds, fertilizer, or chemicals on credit. Repayment is done after harvest or sale. Reduces upfront capital burden but depends on supplier relationships. 10. Leasing and hire purchase. Useful for acquiring expensive equipment, tractors, harvesters, etc. Assets are leased and gradually paid for, helps modernize without huge capital outlay. How to choose the right source of finance. When selecting a financing option, agribusiness owners should evaluate criteria, explanation, repayment terms. How soon and frequently must repayment start? Interest rates. Is it fixed, floating, or subsidized? Collateral requirements. What assets or guarantees are needed? Purpose of loan. Is the loan meant for capital expenditure, inputs, or working capital? Accessibility. How easy is it to qualify and apply for the finance? Equity versus debt. Is the financing source equity-based, ownership, or debt-based, repayable? Scenario illustration. Imagine two agribusiness owners. A. Sarah, poultry farmer. She starts with her personal savings. After 2 years, she joins a cooperative for feed financing. Later, she applies for a Bank of Agriculture loan to expand her housing units. She eventually uses retained earnings to modernize her pens. B. Tunde, agritech innovator, launches a mobile app connecting farmers to buyers, gets initial funding from family, later attracts an angel investor interested in food security. expands with a grant from a USAID program. Each journey requires tailored financing based on the business model, size, and growth stage. Benefits of good financing in agribusiness: improved production and yield, business growth and expansion, increased access to markets, better risk management, improved livelihoods for agripreneurs and workers. Risks of poor financing, choices, unsustainable debt, delayed production, legal disputes, collateral loss, reputational damage. Learning outcomes of Module 3. By the end of this module, you should be able to identify and classify sources of agribusiness finance, understand the conditions, risks, and benefits of each financing type, analyze which financing option best suits specific agribusiness needs, understand the importance of proper documentation and financial discipline,